Everyone, welcome to the webinar from India Avenue. We'll just wait 2 more minutes to ensure that everyone has a chance to get in before we get started. Okay, let's get started. I know that there will be some latecomers, but that's okay. We'll start moving from here. So we just thought we would host this webinar with a view that obviously a lot of things have happened in the world in the last quarter. There's also been a lot of events and issues that have related to India's underperformance over the last 18 months. So we thought we'd share with you some of our ideas and thoughts and how we're positioning the portfolio in light of events over this period and more recently. So thanks everyone for joining us today. We're hopeful that we can give you a grounded view in terms of valuations and positioning. Moving on to the next page of the presentation. Essentially, the agenda that we're covering today is the recent behavior of Indian equities, valuations with respect to that, what the outlook and catalysts are, as well as portfolio positioning, which Edward Heng, who works with me, will talk you through. And then we'll finish up with Q&A. In your Q&A, please use the Q&A function rather than the chat box, as it's easier to moderate and provide the most efficient answering process for you. Okay, so what we're going to cover today is starting with recent performance, then look at valuations in the post-war global environment. And I say post, of course, it's not post, but at least the eye of the storm seems to be towards the back end rather than the front end. And we discuss the medium-term outlook and finish with positioning. Firstly, let's talk about recent behavior, and I'm talking about really the last couple of years. We thought we'd start with this chart. Over the period from FY20 to FY24, essentially March 20 to March 24, India delivered a very strong economic and earnings recovery post-COVID. That period was characterized by robust corporate profitability, healthy domestic demand, broad EM outperformance by India, and it set sort of a solid foundation for long-term investors who are invested. Over the last 18 months, the environment has shifted. Indian equities have faced a challenging period driven by a combination of global and local factors. We've seen initially in September 24, capital markets started to reallocate from India, particularly initially driven by stimulus in China in that exact month of September 24, drawing flows away from India towards other emerging markets. There was also a slowing of earnings momentum after a very strong earnings period in the prior 4 years, and valuations that came off an elevated level, as well as the other side of the equation. India didn't really have exposure to AI, which is where, there was high growth being witnessed, closer to 30 to 50%. India didn't have exposure to companies like Taiwan Semiconductors, which is chips, or Samsung or SG Hynix, any of those sort of companies, which essentially were drawing capital away from markets like the structural stories of India. Additionally, macro headwinds have added to the sentiment drag. Prospect of US tariffs in 2025 being as high as 50%, ongoing foreign investor selling on concerns of this and the general geopolitical environment led to a risk-off global tone that weighed on India's relative performance. At the same time, currency dynamics also played a meaningful role. You can see in this chart that initially Indian equities were weaker in the first half of 2025, but really in the last half of 2025, returns for Aussie dollar investors were driven more by a strengthening Aussie dollar and a weaker rupee in the face of some of the macro headwinds. Finally, the global valuation reset, following and during this West Asia conflict has affected all markets, not just India. Risk assets have been repriced, and that's created a more challenging backdrop in the short term. The key message being, whilst the last 18 months have been difficult, the drivers are understood, largely external, in many cases cyclical, and importantly, periods like this often reset expectations and create the conditions for the next phase of long-term opportunity. Let's have a look at 18 months ago versus end of March. 18 months ago, as I said, the valuations were quite steep, given that earnings growth had been as high as 20% for that 4-year period. However, earnings growth was starting to tell a more telling story by the end of 2024. When we fast forward, when we look at the numbers in March 26, you can see valuations have cooled quite a bit on a 1-year forward basis. Earnings growth is reflecting something similar to what it was in 2024. So India's PEG ratio based on market sell-off has certainly improved. When we look at Brent crude, it's moved from 78 back then to 109, so that's definitely more adverse. Of course, Brent crude is a moving feast. Today, it's back to about 94. CPI was also much higher then at 5.5, today 3.4, increasing, and we think, according to central bank forecasts in India, that we're going to end up somewhere around 4 and 4.5. Now, the central bank's long-term interest rate expectation is 4 ± 2. So it's certainly not beyond the bands of expectation for the central bank. A big factor has been foreign flows in September 24. Based on momentum and India's strong outperformance, foreigners had continued to allocate aggressively to India, taking it to as high as 20% of the emerging market index. Today, there's been, in the last 12 months, 20 billion of outflow, which is the largest by foreign investors, and India's weight in the emerging market index has dropped to 12.5 to 13%. So there's a substantial difference in the way foreign investors have perceived India in the last 12 months relative to how they perceived it in 2024. And another factor that we discussed before was also the movement in currency. We can see that we've moved back then from 57 rupees to $1 to 64.50 to $1. So that certainly has impacted returns, as we saw in the previous chart, for Australian dollar investors. So what we're seeing today is a normalization of growth. India's long-term earnings or corporate growth rate averages 10%. We're not that far from that. We were seeing an improvement in earnings until this West Asia war happened, and we think, to go back to 12 to 15% growth, we're going to have to wait a couple more quarters to assess the impact of oil prices, inflation on margins and demand. Okay, so 3 important things to note when we fast forward really to the last quarter and focus on that specifically. So currency volatility has been high. We've seen not only an India story, but also an Aussie dollar story, which is strengthening due to higher commodity prices, the potential of a commodity cycle, as well as interest rate hikes. Our view is that eventually whilst the Aussie dollar is in strengthening mode, it will have an impact on growth and potentially Aussie dollar in the future being marked downwards after the current phase of rallying. So, this is not necessarily a structural shift. We've seen that in the past. I think in 2010 to 2013, the Aussie dollar actually rallied 100% against the rupee. Whilst that's included in long-term returns, India for a 20-year period has still averaged around 11% per annum in Aussie dollar terms. So we've seen it's not something that we haven't seen before. It's just that we're sitting in the eye of the storm. So we think it's a structural movement. But longer term, India's structural demographics and long-term structural forces remain in place. In Australia, I think there is potential that the currency at some point starts to flatten out. From a Brent crude perspective, you can see a very aggressive move in the last quarter in particular. This is something that we have to wait and monitor how that plays out, and there can't be any strong views that we can make on it. We do know that it's going to impact short-term earnings through corporate margins and rising inflation. Some of that is positive for some companies who deal well with inflation and being able to pass on their pricing, but in a large number of cases, it's also an input cost. So we have to monitor how earnings pan out in light of this. And we can see that the volatility via the VIX which is typically around 17, has risen closer to 20 to 30 over the recent period. So, these are all things that are monitorable and indicate why we've seen the sell-off we've seen globally, which India hasn't escaped from. Okay, now we just move on to valuations. When we're looking at valuations, we thought we'd show you this table, which looks across various regions, including India. It's evident that India has underperformed its peers so far in calendar 2026. Its PE remains higher than cyclical markets like Korea and Brazil, which are offering cheaper valuations for higher growth at present. However, we question if this is necessarily sustainable and if it has high correlation with global benchmarks, which include a lot of AI and commodities as themes. When I look at the EM benchmark today, 33% of it is in information technology. And in fact, the weight of markets like Korea and Taiwan have skyrocketed. You can see, a crazy bullet point there that Korea and Taiwan are 40% of the EM index, whereas India and China added together are 37%. And three stocks, Taiwan Semi, Samsung, and SG Hynix, are together 1.8 times the whole Indian weighting in the emerging market index. So, some of these forces, yes, they do look strong and they do look like AI will have sustainability in earnings, but I think to put all your eggs in a correlated basket will create some concerns for portfolios at some point. When we look at India's relative valuation, we can see here that what we were talking about earlier. On the left, you can see India's 12-month forward PE. This is measured. Our benchmark is the MSCI India, but here we're looking at the top 50 stocks in India. You can see valuations have corrected meaningfully down to around 17.7 times, which is below the 10-year average. India tends to operate at a higher PE given its structural growth story. Last time we saw this level of compression was during COVID-19 and again in 2022 when interest rates were moving up and inflation was rising. In both cases, valuation resets ultimately created strong forward returns. On the right, we can see India's premium to emerging markets historically been higher. Obviously, today, as we said, markets like Korea and Brazil are on lower valuations, offering strong growth. So India's premium has shrunk. It's got to 27% to EM, which we saw again, these sort of levels in COVID. And that's a major reset. It reflects risk aversion, globally, as well as foreign investor outflows, oil-driven macro shock. It's not reflecting necessarily a deterioration in India's structural story, but there are very few opportunities where we get to consider India on a more level playing field with EM from a valuation sense. Now, if you're betting that India's structural story is impaired, then this premium to emerging markets can shrink further. If you're thinking that perhaps the AI play of Korea and Taiwan can play out for many years, then perhaps this premium does come down from where it is. All we're saying is it hit a level of 150 somewhere in 2022 and now is down to 27%. Okay, so where are valuations attractive given this? So private banks, traditionally the area where foreign investors have focused, banks like HDFC Bank, ICICI Bank, market darlings for foreign investors as well, are now trading at a much more circumspect valuation of around 1.5 to 2 times. If you can buy HDFC Bank, which is offering you strong structural story, financialization, penetration in India that could still last for another 10 to 20 years at 1.5 times book, then we feel it's relatively attractive given there's still double-digit credit growth at the moment. Generic pharma is an area that we think presents strong opportunity given the patent cliff that's upcoming over the next 10 years. India's medical infrastructure, which is well set up, many locations which are FDA approved, and the scale and cost economics, as well as the currency currently being favorable given many of the exporters are generating revenue in US dollars. You are also seeing outsourced research and manufacturing hubs being a strong play for India, where lots of firms are outsourcing these areas to India and substituting their current structures in their part of the world. Areas like specialty chemicals and fertilizers obviously impacted short term, but present strong opportunities in a China plus one world, and India has emerged as a strong player in this space. Auto and ancillaries, more and more auto companies in India are benefiting from GST cuts, interest rates being lower, and a strong focus on consumption, as well as their ability to export to the rest of the world. And a lot of the ancillary component part makers of cars are benefiting also from not only just ICE vehicles, but also conversion in many cases towards EVs. So a lot of the component parts like mirrors, steering wheels, dashboards, all those things are made in India. So as the replacement cycle for cars has shortened, we're seeing strong demand come through for this industry. Digitization and technology, the IT services companies in India have derated from, let's say, 25 times multiple to operating closer to 15 times multiple. So we've already seen a substantial pricing in of, is there going to be deflation in services? Is AI going to replace jobs? Is there going to be difficulty for Indian companies? We have seen, however, in early earnings releases from these companies in March ended quarter that they're talking about increased workflow and actually upping their guidance. So we feel over the next 3 years, the focus will be more on integration of AI, where India is one of the market leaders, rather than necessarily, companies focusing on purely job replacements. In the Indian IT firms are actually talking about wage rises, with perhaps a concentration of overhiring that they did in 2022 now being condensed to where the strongest employees have emerged from out of that hiring at the base of the pyramid. So we're not so concerned on the earnings cycle for these companies in the next couple of years. Over the longer term, it needs to be monitored, and they've already derated from where they were to a large degree. We thought we'd also share with you when you look at valuations and where it's come off to, which was around 18.8 times for the MSCI. And we look forward to something like the Nifty, which is not dissimilar to the MSCI. You can see when multiples get to levels like 18 times, we saw that the Nifty 1 year forward was 17.7. Then the average 12-month return subsequently, and the median 12-month return, as well as the chance of a positive outcome, becomes much higher given that you've had this sell down in valuation. And this is using the last 20 years data. This is not saying that history always repeats, but your chances improve after you've had a period of a reset. Okay, so now let's just move on to the outlook and catalysts. We can see from a macro perspective, GDP forecasts, whether it's the IMF, whether it's the World Bank, whether it's the RBI, are all forecasting between 6.4 and 6.9. Yesterday, the World Bank released its World Economic Outlook, which forecast India to grow in this fiscal year at 6.5, and the next fiscal year also at 6.5. So we're not seeing a significant deterioration that's been built in. Perhaps India would have had the opportunity to grow at 7 to 8, and so that's been reined in a bit. But relative to the rest of the world, it's at least 2 percentage points above broader EM and 4 percentage points plus above the developed world. From a CPI perspective, as we said, we're forecasting a rise from 3.4 today to around 4.6 over the course of the year. So that is building in higher inflation due to the reset we've seen on oil prices. The central bank, when we recently met with them on our grassroots trip to India just last month, highlighted that the focus and the bias would be more towards maintaining growth necessarily over guarding against price stability or inflation in the short term. The focus will be to ensure that they do have the opportunity to still cushion some of the weakness in growth over the next couple of quarters that could eventuate through the pressures. When we look at the current account to GDP, it's now at 1.3%. Every $10 rise in the barrel of oil in Brent crude will add about 0.3% to the ratio. We've seen in 2011 when India was really in dire straits with high oil prices and a weakening currency with not much foreign exchange reserves, that this ratio of CAD to GDP went as high as 5%. Today, forex reserves are well north of this. They're above 650 billion, which is close to India's peak in forex reserves. IT services and other exporting industries have brought in a lot of dollars into India, which has certainly boosted the levers that the central bank and the government has in managing the economy. GST cuts have allowed a buffer to be created in domestic consumption, and fuel subsidies have to some degree protected the immediate impact. And most of India's debt is denominated in rupees, so it's not exposed to currency depreciation having a significant impact on its foreign debt. And I think one of the most important factors, which has happened silently, is India has executed 9 trade agreements with over 35 countries in the last 12 months. The push going forward is going to be very much exporting and gaining operating leverage on the industries of advantage that India has created over the last 5 to 10 years. So we will see export numbers coming out higher than previous. We saw actually for March year ended, India had its world not world record, a record number of exports of 866 billion. The focus is to push that closer to 2 billion by the end of the decade. And they might not achieve that, but it's an ambitious goal. But we do think very much exporting industries is going to be the key focus. When we look at catalysts ahead, I just thought I'd touch on what matters most for India in the next phase. The chart on the left shows the long-term relationship between oil prices and MSCI India returns, both in US dollars. What stands out is that India has historically been able to absorb oil shocks reasonably well, with only one period from 2011 to 14 where persistently elevated oil prices genuinely hurt equity returns. In that phase, the combination of high inflation, weaker GDP, slower corporate earnings created a difficult backdrop. The currency also weakened meaningfully, and the current account deficit, as I said, went to 5%. That was a structurally different environment. Today, the setup is India's macro buffers are stronger. As I said, foreign exchange reserves are close to record highs. There's more diversified trade and a healthier fiscal position and a more resilient bank system. And these factors together reduce India's susceptibility to macro shocks, even when oil prices spike. Importantly, valuations have adjusted quickly to the potential earnings impact of higher oil, and markets have priced in a more conservative earnings path, which reduces in our view, the downside risk and sets the stage for recovery once the external environment stabilizes. Key message here is oil remains a swing factor in India's structural resilience. However, strong macro foundations are in place and the valuation reset has occurred, and that we now await the next leg of global conditions to normalize before we see our returns start to improve. Okay, so the risks to monitor from here are oil prices, sustainability of higher oil prices. We think over 100 causes some issues. Under 100, India is better placed to manage that going forward. Global liquidity and sentiment will play a big role, even in directing flows towards various markets. We have the geopolitical environment, which goes part and parcel with the environment for equities today, and the stability of the rupee. All these things will play a role in the immediate risks of valuations, but they don't so much play a role in terms of the ongoing story of earnings and penetration that will no doubt deliver a reasonably strong compounded experience from an earnings point of view. Okay, so I'm just going to pass over to Edward in terms of the portfolio positioning to provide his thoughts.
Yep. Hi, everyone. Thank you, Mukundan, for yep. And I guess from a portfolio positioning standpoint, when we look at the last 12 months, there are two main things to note in terms of outperformance drivers. When we look at the allocation effect, we can see that a huge part of the contribution to negative attribution is sector. And when we look at the specific sectors, we're mainly impacted by being overweight IT. And this is a lot of it has to do with external shocks and also underweight energy and utilities. So we are usually underweight these two sectors, as it's typically not what growth investors focus on, and it has a lot of cyclicalities. And when we look at the stock-specific attribution, we have had a few stock selection detractors in different sectors. It's quite spread out in terms of the sector, healthcare, consumer discretionary, industrials, and staples. And some of these stock-specific weakness are in small cap names. So, for example, Amara Raja, Kaveri Seeds, and Syngene International. And this is, again, also spread out across the different managers. So this spread of sector, style, and manager kind of highlights This is a product of market environment rather than any structural issues. We are also holding a cash of around 5%, and that's slightly higher than historical. So that's helped given the negative return over the last 12 months. We also used some put options earlier this year as a hedging strategy, and this is before the US-Iran war. And so in February, we felt that Nifty VIX was too low, sentiment was too positive, heading into a lot of macro risk. And so this gave us a decent cushion, especially when the war started. In terms of sector positioning we have now, we are leaning in terms of overweights, we are leaning into healthcare, IT, and financials. These are areas where India has strong global capabilities or where valuations have become very attractive. So, for example, healthcare and IT, they benefit directly from currency weakness that supports export earnings. And also, as mentioned before, the outlook for export capabilities is growing. And in financials, we're playing the domestic consumption theme, and this is through cheaper private sector lenders with strong balance sheets. And as mentioned before, the elevated cash position, so currently around 5.5%, this is intentional. This gives us, one, protection during this volatile market, and also the flexibility to deploy quickly as clarity improves. So we want to be more proactive rather than waiting for too long, but we also want to see clear signals first. So this cash position gives us that flexibility. And on the underweight side, we continue to be underexposed to energy and utilities, and also consumer staples and industrials. So these sectors tend to be lower growth, more regulated, and more cyclical. Consumer staples in particular is also expensive and low growth. Industrials have been trimmed also due to cyclicality and stretch valuations. And so this position reflects what our views are, and also still a structural view where India is globally competitive. Another way to, I guess, observe our portfolio from this perspective is when you look at the size breakdown, in the last 18 months, we've been reducing small cap exposure, and this is intentional, and rotating capital into large caps. So in the left-hand chart, you can see that very clearly, and this is since the end of 2024. And so small caps at that point has run very hard. Valuations become very stretched. Liquidity conditions have also tightened. And in that environment, large caps also offer better risk adjusted opportunities, so stronger balance sheets, more predictable earnings, and better resilience during global risk-off periods. So we were intentional in making that switch. And in the right-hand chart, that also is reflected in our active share. So we've been reducing the active share by playing this small cap and large cap weight, and also reducing some of our high beta exposures. So this is a disciplined response to, at that point, a market dominated by macro volatility, which still exists at the moment, elevated valuations, lower earnings growth profile, and liquidity tightening. So during these periods, the payoff for taking high active risk diminishes, and the focus shifts to protecting capital and maintaining that flexibility. So as macro conditions stabilize and earnings visibility improves, we expect to gradually rebuild that active share and re-engage more selectively across mid and small caps. So we're still waiting for more clearer signals, and also for better entry points. So when we look at how we're positioning in terms of what we're trying to look for, the focus right now is finding growth at reasonable valuations. So in the chart, the horizontal axis is the free cash flow yield, and this represents valuations as measured by cash flow, and the vertical axis is the next 12 months earnings growth. So 0.0 is the index. So that's what we're comparing ourselves against. So anything in the top right quadrant reflects better growth at lower valuation. And that's where we want to be. And you can see that throughout the inception of the fund, we have been in that area. And so This is something that we've been quite disciplined in doing. We haven't deviated from that. As you can see, the green marker for March 2026 highlights where the portfolio sits today. In a risk-off environment, markets reward companies with balance sheet strength, pricing power, and predictable earnings. So we are being disciplined in our approach. We're avoiding the high multiple momentum-driven parts of the market and focusing on the quality growth at sensible prices. As we navigate this period, our focus has been on, again, this resilience of the portfolio, while also making sure that our long-term process maintains. We're not veering away from our structural views or any of our philosophy. So the first step that we did was where we added a fourth investment advisor. And this is a manager with strong track record in earning stability and visibility. And so that provides a lot of stability, especially in this environment. We've also reduced stock-specific and style risk. So this means just fewer concentrated bets, less exposure to extreme factor swings, and tighter alignment to quality and earnings visibility. Again, this has been that process for the last 18 months, but we're still sticking by that at the moment, while having that flexibility to deploy when things are clearer. And some of the levers we have are, I guess, higher beta advisors, reducing our cash positions, and rotating between advisors, which we feel like will provide higher beta, higher active risk. And throughout all of this, we try to maintain as much as we can to the long-term structural story. And this is because like our process has been tried and tested. This has done well across multiple cycles. And so we hold fast to that. Yep, so before we go to the Q&A section, Mukundin would just quickly summarize the presentation.
Yeah, thanks, Edward. So yeah, look, I'll just wrap up quickly and then we'll go to Q&A. So, we think this environment, the reset from a valuation point of view, initially was India related in that 18-month period. It's moved more now to a global related reset, which we've seen particularly in the last quarter. India's structural story remains intact. We think nominal GDP growth and earnings growth are likely to converge as they have in the past towards a long-term average of 10 to 12%, which should drive market returns going forward from a more sanguine valuation. And Edward talked a lot about the defensiveness and the diversity that we've built in the portfolio through adding another manager to increasing our exposure to small caps, even though structurally our view is the sweet spot is more in the breadth of the market. We are still positioned well to be able to be nimble. So far this month in April, the portfolio has seen an uptick of about 8% as of last night, which is similar to other markets. But what we've been able to do is reduce our cash to minimal levels and think about who are the advisors we would allocate more funds to if the market was to recover from here. We're not still 100% sure that we're, out of the woods and there's a light at the end of the tunnel and everything's hunky-dory. But we do know that, where new allocations of money that come into the fund should be directed towards to give us access to potential for upside. A lot of the small caps have been sold off quite aggressively over the last 18 months, small caps that we owned more of back in September 24. Some of these companies are where we'll be going back towards slightly higher weightings because our view is their valuations are now far more conducive to an improvement in the cycle. So we just thought we'd provide that as a summary. And now we can, these are the fund details, which most of you know. The fund is available via PDS, multiple platforms, and is now also available via an ETF. And apart from that, nothing much else has changed. The fund is easily accessible for all investors. From a disclaimer point of view, we have to show you this, which essentially discusses that this is for sophisticated investors, being either professional investors or financial advisors. We're available on LinkedIn for any of you who want to follow us material, the research that we put out, the grassroots tour that we recently did, and all our thoughts around what we saw in India. Then LinkedIn is the best way to follow us and follow our thoughts. Edward, is there any questions that we need to?
Yes. So the first question is about the corporate balance. Corporate balance sheets in terms of gearing and how our portfolio is doing in regard of that, and also the environment.
Yeah, so India is at a place now where the corporate balance sheets are the healthiest they've been in the last 25 years. And what do I mean by that? The debt to equity ratio is less than 0.5. This is, a indication of the prior environment where lots of Indian companies spent time deleveraging after the last cycle. And that has meant, strong cash flow generation. Firms are well placed to withstand any sort of hardship because of their positioning and strong cash flow and low debt levels.
Yep. Maybe just a question from myself as well. I guess if oil prices were to persist, how would the outlook change?
Yeah, so we saw in 2011 to 2013, India was part of the Fragile Five. Its currency was weak, current account deficit was high. It went through substantial stagflation. And in that environment, it wasn't a great place to invest. If there's sustained high oil prices like there were in that period, above $100, then it is certainly going to create an impact on some industries in India. However, I would say that it is much better placed than where it was. In 2000, India had a 93% reliance on fossil fuels as its energy source. Today, that's dropped to 75. The target is to get to 50 by 2030. So I think, yes, it's still a significant importer of fossil fuels, but the reliance is improving, and renewable energy additions are now close to 80% of new incremental capacity. So I expect over the next 5 years a significant push by the government towards renewables and directing resources to that space.
Yeah, thank you for that. The next question is regarding USD. So if USD were to rally, how would this impact India?
Yeah, so I think the India rupee, or the rupee, has already depreciated quite substantially against both the USD as well as the Australian dollar. We've seen really 2025 was a weak point for the currency. This was driven by foreign investors selling off, as well as impact on the sentimental view from the tariff positioning. We know now that India's tariff rate is far more favorable. And actually, when this war ends, it allows it to trade far more freely with many more regions. And we also know foreign investors are now substantially underweight. So the chance for them to go even more underweight is reduced. So we think after an exodus of outflows, there's certainly some manageability around the further currency weakness. And we think for Aussie investors, the story is more, will the Aussie dollar strengthen a lot? Or have we seen the brunt of the strengthening already? Okay, so look, it looks like questions are up and we're also running out of time. If you have any further questions, please shoot them through to ia@indiaavenue.com.au. We will get onto those questions as soon as possible and get back to you. And if you'd like to catch up for a deeper discussion or a discussion about our recent tour to India, we'd be more than happy to do so. Please reach out. Thank you, everyone, for attending. And it's always a great opportunity to talk to you in this format. We look forward to having regular quarterly webinars going forward from here. Thank you. Have a good day.